While most people spend December writing New Year's resolutions, you and I are going to do tax planning before December 31st because that's where the savings live. I'm a CPA and a business owner, and I see these moves create real savings every year. There's a difference between filing your taxes and doing tax planning. And today I'll walk you through 10 completely legal strategies that work when we document them the right way. Let's start with the first strategy, accountable plan reimbursement. If you own an S Corp or C Corp and you are paying for work-related items like your home internet, or your cell phone, computer, or part of your home office out of your pocket, I want you to stop doing that. We will create a simple written accountable plan, and the company will reimburse you for the business portion each month. As a result, the business can deduct these expenses and they're tax-free to you. For many owners, this adds up to $5,000 to $15,000 or more a year that was simply missed, and you just need to document it the right way. Moving to the second strategy, let's use a $2,500 equipment write-off. When a work item costs $2,500 or less per item, or invoice things like laptop, monitors, small tools, you can usually write it off in the year you buy it, instead of depreciating it for years. Your tax professional includes a short election with the return and you are finished. If you already plan to purchase early year equipment, it can make sense to place those orders in December so that the deductions can land this year. The third strategy you can implement is about software implementation. A lot of people record the subscription and forgot the migration, integration, setup, training, and onboarding when they change system. If those invoices are labeled clearly and kept with a short project summary, they typically belong in the current year deduction, and the support is easy to show later. Since we're already cleaning up your coding, this is a good time to do it. Before we leave your book, the fourth strategy is to capture processing and merchant fees. Things like Stripe, Square, PayPal, and similar processors net their fees out of your deposit, so those fees are easy to overlook. They are a normal business expense, and many companies leave the $10,000 to $15,000 unclaimed simply because no one exported the year-to-date fees report and check it. So please export those reports before December 31st so that the full deduction is recorded. The fifth thing I want you to look at is education that support your current business. Graduate degrees from Harvard, etc. are generally not a business expense, and programs that improve the business you already run, including masterminds, targeted coaching, and specialized training, usually qualify. When you enroll, keep the receipt, the outline, or the syllabus in a one-sentence note on how to improve your current operation. By the time we reach number 6, we should talk about smarter health benefit, QSEHRA or ICHRA. Traditional group health insurance is not your only option. So with the QSEHRA for small team or an ICHRA for more flexibility, your business can reimburse employee health costs in a tax-efficient way with lighter administration. If this is your team, we will start the setup now so that it can be effective January 1st. Number 7 on my list is structuring community support as a sponsorship instead of a plain donation. So if you want to sponsor a local event or a charity initiative, you can include your logo on the material, a mention from the stage, a table at the event, so that the business treated as advertising. You still support the community. The expense is generally taken as a straightforward marketing deduction. 8. I want you to identify meals that qualify for 100% deduction. Most business meals are 50% deduction, and there are categories that allows a 100% deduction when the event is primarily for employees. Events like company-wide social event, or holiday gathering, a genuine employee appreciation day, or like an internal team building meal can qualify when you document the purpose and the attendees. Please label these clearly, and then you can recode any eligible receipts before year end. Number 9, if this is your first year in business, we need to capture startup and organizational costs. You can deduct up to $5,000 of startup costs and up to $5,000 of organizational costs in the first year, with the remainder amortized over time. So please gather the pre-launch receipt, formation documents, and then the professional fees so that we can put them in the books now. And then finally, number 10 is the Augusta rule, section 280 AG. Your business can rent your personal residence up to 14 days per year for legal business purposes, such as board meetings or planning meetings or Christmas parties for employees. And then companies can record a rent expense and you receive that rent tax-free. We'll set a fair market daily rate and then keep clean support, things like calendar invites, agenda, minutes, and then photos of the setup, and then the local render comms so that the file is complete and defensible in case of an audit. Now, as a quick bonus, I want you to remember that the difference between repairs, improvements could be huge. A repair restores what you already have and is generally deducted now, and an improvement adds value or extends useful life and is usually depreciated over time. So the description on the invoice matters, and when it's accurate, you can ask the vendor to describe work as repair to restore original function. That single sentence often moves the cost into the current year deduction. Here's the action plan I recommend for this month. You will add or update the right categories in your accounting system so that these items have a clear home. You also put processor fees reports and view your meals and employees event categories so that we can recode anything that qualifies. You'll create a simple documentation folder for each strategy, things like policy, receipts, screenshots, agenda, minute, and photos when helpful, so you have the proof at tax time. And you'll meet a tax advisor who focuses on tax planning, not just year-end compliance, so that the decisions you make before December 31st shows up as deductions. So none of this is complicated once it's set up, and it adds up when you do it before the deadline. If you would like my template, the accountable plan policy, the Augusta documentation package, and December checklist, comment December and I'll send them to you. In the next video, I'll show you exactly how to document each strategy so that everything holds up under scrutiny. Your wealth is not built in April when you file. It is built now in December when you plan ahead and document things the right way. So let's do it together.